Welcome Rosemary to the lectern.
Okay, so I'm here to talk about CPI plus 4 and probably from a little bit of a different angle. So let's hope there's a disclaimer which you'd all be familiar with. So I want to touch on a few areas. What are really the right objectives for funds and what does CPI plus 4 mean to members? I want to take you on a bit of a journey through what a member's view is and what really a sort of average returns are, but what do members perceive that as? And then go back to where do we think CPI plus 4 will, is it achievable? Where will it come from? So first I want to just touch on that, the session titled CPI plus 4, is it realistic? I'd have to say no. And the reason being that CPI plus 4 is an average kind of concept. But in fact, your members are not average. There is not one, conglomerate member in your fund. There are all different members in your funds. So first off, members actually experience internal rates of return. Now you might have heard this concept coming through in your infrastructure debates or your property debate, the concept of IRR. Well, that's actually what members get. They get an IRR depending on their own cash flows and account balance. Their age comes into importance here because we know that at certain ages, members have more money in the market. So they're building up through sort of 50s, 60s before they start to decline. So age and account balance comes into this. So really, there is not a conglomerate member. There is not an average CPI plus 4. There are different members with different internal rates of return. And so we certainly believe that different economic environments, the age of your members, the level of their account balance or their fundedness really affects what the goal is. So first off, I don't think CPI plus is the correct measure going forward over a number of years. What does it actually mean to members at the moment, CPI plus 4? Well, for a start, do you actually understand the probability of your fund achieving it? Right? So when we talk with our sort of investment colleagues in funds, they all know it's not 100% certainty of achieving the stated target. So do you actually know what your fund probability is of achieving the target? So if it's CPI plus 4, it might have a probability of achieving it like 60%. It might be over 5 years or 10 years or whatever your time frame is. But you might actually choose to have a lower target and a higher probability. So this whole debate over how certain it is that members are going to get that return, that debate hasn't been had very much in the industry. In fact, there's no information really publicly available on your probability of meeting your target, right? I keep thinking about the car's got to get to the destination. So is your fund one that's got a high success rate? Does the car get to the destination or not? So that debate, I think, over coming years will be forced upon us by APRA. That is, in PDSs at the moment, you do not pick up any information on what the success rate has been in achieving the target, and certainly not on member statements. So we've got this success measure out there. You don't know how certain it is you achieve it for the fund as a whole. That's not published. And then the individual member doesn't actually receive that anyway. They get their own personal internal rate of return. CPI plus 4 or 3.5 or whatever at the moment, in terms of member understanding, is probably quite a lot different to what we think. We went through so many years of good returns, but CPI at the moment is a bit over 1%. So CPI plus 3.5, members should be happy if we're giving them 4 or 5%. But I'm sure that wouldn't have been their experience. Their experience was double digits. So we've got this, I guess, concept that was built up over, the 80s and 90s. But in reality, we have to take that back. We have to take that perception back from members, because CPI plus 4 in a low inflation environment is like 6%. So we have this whole, I think, artifice that the industry has created about something that no one receives, something that's not published, and something that was grounded in economic environments of a decade ago. So no wonder we have disconcerted members. A way I'd like you to think about this, if you like, is we know what life expectancies are in this industry. We think in those terms. 65-year-old male, the life tables say, their average life expectancy is 84, 19 years. But you know and I know some people die sort of then, tomorrow, or a 65-year-old man might live to 65 and a half or 66. Some will live out to 100. The average is simply the middle point. So I'd like you to think about that in terms of super fund returns. Now, one of my favourite publications actually just came out last week, and it's a little bit strange, but I suggest you all get a copy of the September Super Funds magazine because it has a whole lot of data in it that I keep each year. It shows all of the average returns and CPI and AWOTI, and it goes back, a lot of years. This shows the 10-year, this is not short term, this is extracted from this report, the 10-year numbers for super fund returns. The average was 9.7 in this decade, for a 10-year period between 92 and 2011. So really it would go back to 82, that first 10-year period. 9.7 is the average. But like life expectancy, some members experienced as low as 4.5% for 10-year numbers, for decade-long numbers. And some funds got 16.5%, thereabouts. CPI plus 4 for an average fund was last achieved in 2007, 5 years ago. Now, really, times have changed, times have moved on. So I'd like you to think, as I say, about what's the point of an average? Are you understanding, measuring it, etc.? But really, what's the whole experience in your fund? Here's a fun little trick, and I've seen it done before. This just looks at a member, 45 with $20,000, and say, we're going to put in $6,000 a year. That's roughly 9%. On 55,000 thereabouts. Now, the average return for super funds at this period was 7.8%. So you'll see that at the bottom. But if you flip the sequence of returns and work out the internal rate of return, one got 6.7 and the other got 8.4. It made a massive difference in the account balance. So once again, averages don't have meaning. The sequence of returns and when members actually have money in the market is what makes the difference. So how much are we really managing to CPI plus 4? In my trawls through a number of PDSs, peer relative measures do come up, and in fact, one major fund listed them first. One major fund listed their first objective as beating median funds. But nowhere did I see the success rate of achieving the objective. So they talked about this is what we've received, these are the returns we've received, but funds don't map that in their PDSs. They don't actually tell members, well, how is that compared to the CPI plus that I set as my target? Now, peer returns may well be suited, and they certainly were through those sort of golden days, but, in essence, that's a sort of a short-term measure. We need to really be thinking much more long-term, and in essence, what we've been finding, because this is an investment conference, what we've been finding is the only steps we can take is a move towards greater diversification. Now, you'd all understand that we are in a particular economic environment, and I guess I think in very macro sense. The world borrowed, the world spent earlier than it should have, and it's paying it back now. So how long before we get out of it? Well, there's still some paying back to be done. Cash rates are extremely low. Quantitative easing, QE, is pushing more money into the system. So returns are falling on all assets. Cash rates are falling, returns are falling on all assets. When you look towards what's happening in the US and you say this new term, the United States fiscal cliff is coming, well, what are the solutions? Well, really you sort of raise taxes, reduce spending, or you push the problem out and out and out. All of that adds up to just less consumer spending, right? Less consumer spending, which means, less economic growth. When you think in equities terms, there's really a couple of ways you get returns on equities. You get obviously a sort of a cash rate. You get the return from economic growth and a return from a risk premium on the asset. Well, cash rates are falling and economic growth is falling. So really what do we see as sort of long-term returns from equities? We certainly see they have to be subdued into the future. So the sorts of things I guess we've been turning our mind to in this CPI plus 4 world or CPI plus world is really how much dominance in our portfolio has there been of equity risk. So you might have 65% in average funds in equities, but if you actually look in a risk sense, because equities are more volatile, there's something like 85% equities risk in the fund. So look at the sources of risk, not just the asset allocation. We've been turning our mind to more bond risk. Now, I've heard many a comment back to us of, just wait till interest rates rise. Some of that is quite naive. If you actually think about bonds, they're like any other asset class. They don't all have to be the same. So you can actually work on, well, what type of fixed interest returns do I want in my portfolio? And you can go, longer duration. You don't have to necessarily hold them all onshore. You don't necessarily have to hold them all sovereign. So there's different ways you can get bond risk into the portfolio. There's different ways you can get alternatives into the portfolio, and I certainly know that, in particular, the industry fund movement's been quite strong in getting alternatives into the portfolio. And again, they have quite idiosyncratic risks. Not all private equity is the same, I'm sure you know, or not all infrastructure is the same. But they do bring, if you can get ones that you're happy with, they do bring, hopefully, manager skill into play, and they hopefully do bring in an illiquidity premium. Now, certainly once you understand the sort of sources of risk in your portfolio and a desire to diversify that, you may well find that some of what we've said here, some of the first steps actually add a lot. By that, once you say, gee, do I want 85% of investment risk in my portfolio coming from equities? And you say, well, gee, maybe not in a subdued economic environment for the next X years. Well, then you have to think, well, what other investment risk could I get into the portfolio? So obviously equities are great when economic conditions are great, but really when in recessionary times, they're not always wonderful to have. In essence, though, I go back to sort of where I began. I don't think CPI plus 4 is realistic because I actually think it's the wrong measure. It's a measure no one receives, no one is being measured on, and members probably wouldn't be happy even if they were getting it. So the whole notion of managing much more individually and much more thinking about the actual order of returns, the internal rate of return a member receives, is where we think that funds will be heading over time. Thank you.
Good afternoon, everybody. Now, look, I know it's normal for you to put a disclaimer at the end of a presentation, but could I make my disclaimer first? I am not a catastrophist. Now, I know we've had a few catastrophic scenarios painted for us this very day, in fact, but I'm not one of those. In fact, I'm reminded of this, my attitude to catastrophe thinking or millenarianism. As some of you know here, I was a journalist. I'm a journalist by background and was an editor of the Australian Financial Review. And one of the earlier editors before I was editor was Max Walsh. And I used to always tease Max, who was a noted bear on many things, that he had predicted 8 of the last 2 recessions. So that's my disclaimer. I'm not a catastrophist. Okay. Now, Rosemary and I had a brief discussion before this, and we have a range of views but that don't always agree, but I must say it's a Viva, actually that's the misspelt one, but there you go. I've got this is an earlier slide presentation where I made a correction to Vilgan, so it's not the right slide sequence, but that's okay. Viva la Vilgan difference, because the idea that differentiation, age, wealth, assets, appetite, risk appetite amongst members, and the knowledge of members is an important part of the way we as fund custodians, if you like, should approach things. But the problem is that there are 33 million differences in Australia, and even if it's 12 million, which is what the total number of funds, the total number of people with superannuation accounts have, in Australia, that's still a lot of consolidated differences. And I'm a little concerned with the approach to the differentiation that's being proposed. Is our superannuation system, the administration of it, our investment options, the financial advice that we receive with around about 16,000 planners all coming out of a conflict zone, is it capable of managing and promoting such discrimination and differentiation? And I'm not really sure that I'm confident of that. But the real problem is the baby boomers. Now, we all know the baby boomers were born after World War II. They were going to uni and finishing off their schooling in the late 60s, smoking a lot of dope. They're used to throwing their weight around. And as they approach retirement, which many of them are doing right now, they are moving to preserve their superannuation accounts. But the impact on the asset allocation of that process is having an impact on the way we as funds manage for everybody, except that what we're really doing is managing a de-risk, or a tendency to de-risk our portfolios for what really is 10 or 15% of our total membership. For instance, MediaSuper, the fund that I'm the chair of, has less than 10% of its membership older than 55, but the debate around the board table and around our investment committee regularly turns on currently de-risking our balanced portfolio. So I think it's a looming problem that we're getting a disjunction between taking proper measures to deal with our objectives when we're listening to only one small segment of our membership. So, CPI plus 4%, is the bar too high or too low? Now, what APRA wants, does APRA really get? Well, as we heard yesterday, APRA has got new Prudential guidelines and they're going to affect investments, and it involves disclosing target returns and our risk profile. So for our default funds, we're going to be needing probably an inflation plus disclosure, or will it be a 1 negative in 8 disclosure, or will it be simply left to investment choice, and as far as APRA is concerned, under those circumstances, you're on your own. Now, there's been a compounding of a problem, the row over standard risk measurement, the problem of risky risk. And to compound things, it's not been helped in recent months by our colleagues at the Financial Services Council and at ASFA who've proposed a measure to APRA, which in AIST's view, the regulator prematurely accepted, which we believe is not an appropriate long-term performance risk-adjusted target. It's more like a short-term volatility measure. So we've got a problem there. Okay. We've heard a lot of talk today, a lot of talk yesterday about the general economic environment. So what is the new norm? If you think that the noughties, the period from 2000 to 2010, are the new norm, will that mean you expect 8 negatives in the next 20 years? Because that's what actually occurred. In the noughties, there were 4, broadly speaking, our industry, right across it, encountered 4 negative years in that 10. So if you think that that's the new norm, then it'll be 8 in the next 20. And by the time I'm just dead, but I won't be that long dead in 2050, actuarially, there will have been 16 negatives before that period has ended. Well, really, who's pulling whose leg here? Do you actually really believe that that's going to be the outcome? Because that's what's implied by claiming that this is the new norm. I don't. As I say, I'm not a catastrophist, and that seems to me to be a catastrophic outcome if that was the case, and thus you'd have to really say that the socialists had actually won and that capitalism wasn't a system that was going to deliver up, if you really believe that the new norm is the last 10 years. It clearly does mean, however, getting our asset allocations right, and Rosemary's talked through some of that in her presentation about how you actually do it to fend off the negatives, but also to deal with the question of CPI plus 4. It also probably means figuring out some way to pay our investment professionals to make sure that our CIOs and CEOs do produce a result that we as trustees are happy about. To get a bit of an idea of where we're at the moment, I thought, why not use my own fund, MediaSuper? Here's a case study. Over the past 3 years, now these figures are to June 2012, so they're recent, but of course the past 3 years therefore dropped off that negative, our worst year for the past decade, which was a negative 6%, the 2008-2009 year, 5.08%. Well, actually that's not CPI plus 4. In fact, it's CPI plus 2, if we accept Michael Blythe's reference yesterday to CPI sitting somewhere between 2 and 3%. The past 5 years, clearly that's not CPI plus 4. In fact, it's negative 4 and a little bit, in fact. The past 7 years, it's not CPI plus 4, it's CPI plus about 1. The past 10, it's getting a little better. It's creeping towards CPI plus 2. The past 15, that's getting better. We're getting pretty close to it. But since inception, and the fund has been going for 25 years, that is CPI plus 4. Now, APRA produces data for whole of fund. So that I know that there's a lively debate goes on about the appropriateness of the APRA data because a lot of it's aggregated, and this data is also a little dated, which is why MediaSuper's results look better than this. But this is actually for the year to the end of June 2011. So therefore it's not comparable to the previous slide because it includes that big 2008-2009 negative figure. But I included here to give you an idea of where the market, more broadly speaking, is over various periods. And you can see there industry funds with a varying result. It's only at the 15-year level that you're getting somewhere close to CPI plus 3. The retail funds figures there are comparable to the industry fund figures. And then the the most attractive kid on the block at the moment, the self-managed super funds, but who really knows? The tax office data does suggest to me that there's some survivor bias or some pretty poor counting, and size, as I mentioned there, definitely does matter, because the 2010 results that are produced by the tax office suggests that if you had an SMSF that had more than $2 million in it, and there are a significant number that are, you would have made last year plus 8%. But if you had an SMSF that had between $50,000 and $100,000 in it, and we know that a very, very large percentage of all SMSFs are in that category, you would have last year have lost 1%. And if you had, these are just aggregated figures that are maintained by the tax office, if you had an SMSF with $50,000 in it, and there are a lot of those as well, you would have lost 8%. So the range is much, much wider. My general view on this is we should not be spooked. That period, 2008 to 2012, yes, it's been a difficult year, a difficult series of years. And the decade of the noughties has been a difficult decade, but it has been like the curate's egg. It has had some terrible years and some terrific years. And the argument against regarding the decade of the noughties as being the new norm is, it seems to me, the same as seeking to take away what's deemed to be the long moderation, where funds like Media Super and virtually every fund in this room that started in that period in the late 1980s did enjoy the results of the long moderation. But you can't just simply exclude them and say that that's not part of the system. That is part of the system. But it has been a doomsayer's picnic in recent times. The next 2 decades, it will be a matter of asset allocation. And in the end, that comes down to making a judgment about 2 simple things: debt or equity. You can subdivide it quite a lot, but in the end, it does come down to those 2 major asset classes. And finally, I'd just like to leave with you what's probably to some a pretty picture. Now, Capability Brown, I'm surprised that when I talked to a number of people, they didn't seem to know who Capability Brown, but Capability Brown, whose real name was Lancelot Brown, was an 18th century English landscape architect. And what Capability Brown used to do was he would go into what effectively would be a paddock, and he would plant, or order to be planted, poplars over here, elms here, 6 oaks there, to dam this small pond and make it larger, or dam the small river, small creek and make it larger, have it serpentine and wander through the landscape. But what he was actually looking at was an open paddock. And the results, such as this one, which is one of his creations, was only evident 150 years later. We're not creating a system for baby boomer retirees. We're long-haul investors. So in my view, we should hold our nerve. We're capitalists, right? So we should maintain a risk appetite and not fall prey to short-term thinking. And remember Capability Brown. Thanks.